I want to talk about momentum investing. Momentum investing essentially is an investment strategy that emphasizes buying stocks in a company that is doing very well and selling stocks of a company that is performing poorly. Essentially, you buy companies that are in an uptrend and you dump those ones that are on a downtrend. Momentum investing actually is more of price based than fundamentals. They don't really consider much of the fundamentals of the company, but they rather concentrate on the price movements, the price performance, the relative price performance of the stocks they want to buy. And so these essential steps are very important in momentum investing. Number one, identifying momentum. Before you buy the stock, you must first of all identify the momentum attached to that particular stocks. Is it an upward momentum or is it a downward momentum? And if a stock is doing very well, had outperformed over a period of time, that particular stock is a very good candidate for momentum investing. So the investor here buys the stock with the hope that the stock will continue to appreciate, will continue to climb. The stock price will continue to do well in the near future. And then sell the stocks of companies that happen to be doing not very well, performing poorly, stocks that are going downward, that are taking a downward trend. And so those stocks are to be sold. So you buy the ones that are doing very well and sell the ones that are performing poorly. But first of all, you must identify the momentum in these regards. Number two, entry and exit points. Since momentum investing is more of a price-based strategy, it's very important you buy at a price that is considered low enough and also exit your position at a price that is considered high enough. And so in this regards, price is very, very crucial. Price is significant and price is important. It's an important determinant of whether a momentum investor will invest in the stock or not. And when the stock starts going up, when the stock starts appreciating, when the stocks embark on an upward trend or growth, the momentum investor buys into the stock. And when the stock has appreciated enough, the investor concerned is expected to sell his position and then look for another candidate, look for another stock to buy. Number three is risk management. Momentum investing is relatively risky. It's risky in the sense that these stocks are not really, the investor is not really concerned or bothered about the company's fundamental. A momentum investor is essentially concerned about the company's price trend. And so for the fact that you are getting involved in a speculative, risky investment strategy, it's important that you consider risk management. And risk management here will involve placing a stop loss, on the stock you are buying. This incorporates a kind of, involve putting a stop. That is, at a particular price, the stock is sold automatically. In other words, when the stock is going down, the stock will not go below the price you set. If you set your stop loss at, let's say, $2, immediately the stock goes down to $2 automatically the stock is sold so as to avoid potential losses. And you can equally set, a trailing stop to lock in your gains. That is, as your stock is gaining momentum, is getting appreciation at a predetermined price, you can sell your stocks so that the stock will not, eventually go lower than the price you set. And so you kind of lock in your gains by setting a trailing stop, and then you curtail your losses by implementing a stop loss. So these methods of risk management is very, very important in momentum investing. Number 4, market condition. When it comes to momentum investing is based on the condition of the market. In a typical bull market, the stocks in the market tends to go higher, tends to appreciate at a faster rate. And in a bear market, stocks tend to take a southward dive. They tend to nose dive, downward. And momentum investing is very good in a bull market. When the market is moving sideways, it's not encouraged to embark on momentum investing. But when the stocks are going very high, are going high relatively, uh, as it's being dictated by the market condition, you are expected to buy at that instance with the belief that the market will continue to do well and the companies in your portfolio will equally climb in line with the overall market condition. And so bull markets tends to encourage momentum investing. So you are not expected to embark on this kind of investing strategy in a bear market. You will stand to lose your capital considerably. Please, I would advise, I would solicit you give me a thumbs up and also subscribe to this channel. Press the notification button and it will do me a ton of good. Lastly, number 5, back testing and research. You have to research critically. You have to research extensively. And you equally have to back test your strategy and see how the strategy does historically, considering the kind of stocks you are buying or the kind of assets you are buying into. And so back testing is very important. You try to analyze and see how the strategy worked in time past compared to what you want to get involved in the present. If your strategy had been working very well in time past in relation to the nature of stocks you want to buy, you can go ahead and then buy. If you backtest and it indicates that that strategy hadn't worked with that nature of stocks in time past, then I wouldn't advise you key into this strategy. So you backtest and you research critically to ensure that you don't commit your hard-earned capital into a strategy that will not yield the kind of result you expect to obtain. So it's a very speculative kind of investment. So take your time to ensure that you know what you are doing, or else you may buy a stock, and if you don't implement a stop loss order, you may end up losing substantially as a result.